Now let's get back into the October jobs report, which showed employers added 531,000 jobs in the month versus estimates for 450,000. Keith Lerner is the co-CIO over at Truist and joins us now. Keith, your hot take.
My hot take is this really confirms one of our major themes that we've been talking about really for the last month, is that we are set up for positive economic surprises. The summer slowdown is in the rearview mirror. And, if you think about that summer slowdown, Brian, that was caused by the COVID numbers coming up pretty dramatically. Now we've seen those numbers come down dramatically. I think people got too bearish on growth. And what we're seeing is that this economy is still robust, and we continue to expect above trend economic growth into next year.
Keith, this is Emily. What does this jobs report mean here for the Fed now?
I don't think it really changes the equation. I mean, it's one report, but I think it definitely kind of confirms that they will taper. And the reason why they're going to start tapering, because we are no longer in crisis mode, and therefore we should be taking away some of this liquidity. I think if we continue at this pace, that could kind of change somewhat as far as the pace. But at this point, I really don't think it changes the equation. But I think it's a good sign that we have good job growth. And, I heard on the earlier segment that, we're still, several million jobs below where we were prior to the peak. And that's true. And we want to get those jobs back as soon as possible. But in context, if you
I think we lost Keith there momentarily, Emily. But I think Keith was talking about really just this pent up demand that continues to be in this economy as the economy opens up. And again, we're seeing that in some of the positive jobs numbers that we got really in today's report.
Absolutely, Brian. And, I think what was especially encouraging here, not only that headline number that we got for October, but those upward revisions that we were looking at for both August and September here. Now, we know that September especially had been a deeply disappointing report. Just some 194,000 jobs had been brought back. Those were actually upwardly revised to more than 300,000. So we know, of course, that the Delta variant and the wave that we saw in late summer into September had exerted some pressure on the labor market, had kept some workers on the sidelines, but it does appear that those concerns were starting to dissipate here. So definitely something encouraging on that front as well. And then, of course, also taking a look at the unemployment rate, seeing that drop to 4.6%. That was actually a bigger decline than we had been expecting off of the 4.8% in September. Of course, if we just put this all in context and where we are relative to where we were before the pandemic, still a ways to go here. Of course, the unemployment rate in February 2020 had been at a 50-year low of 3.5%. And as Brian Chung was mentioning in the first half hour of our show, we are still down by about 4.2 million jobs compared to those pre-pandemic levels. And the civilian labor force is also down by a few million as well. So again, we are continuing to make job gains here. We've had net payroll growth in every single month so far in 2021, but still not quite enough to make up those losses that we saw with that plunge in employment in both March and April of last year, Brian.
Yeah, and as we mentioned in our special, Emily, really one thing that caught my attention was leisure. I mean, those leisure jobs were up 164,000, really dovetailing off some upbeat earnings calls over the past 2 weeks from a Hilton, a Marriott, and then Airbnb last night. Let's get back to Keith Lerner. I think we got him back here. Keith, one thing, maybe I am reading a little too much into it, but I'm going to continue to play this up all morning long. Is this market reaction to this report a sign that the market is okay and it can handle higher interest rates, maybe 1 or 2 increases next year to combat inflation?
That's right. I mean, if you think about, first of all, going back to the taper, we go back to 2014. That was when we really tapered and the market was up, 10% that year. And this has been very well telegraphed. We also look back historically at 15 times that we've seen an interest rate or rising rate environment since 1950, and you've annualized at about a 12% return for the S&P. So listen, I think we will have a more modest market next year. I think you will inject some volatility around the Fed, but I think the primary trend is still higher in our view, and the market can deal with slightly higher rates if it's because the economy is doing better.
Keith, we've had 6 consecutive record closes now on the S&P 500. Of course, we entered October with what you mentioned had been a little bit of an oversold territory in September. What do you think is priced into the market right now? And is there perhaps a little bit too much optimism and frothiness now with these continued record highs?
It's a good question. As you mentioned, we came into September, telling our clients to use that pullback to position for strength into the fourth quarter. And this, we've rebounded already 7%. So, our feeling is that you'll likely start to digest some of these gains. But ultimately, if we continue to see these positive economic surprises, we still expect upside. Just another stat, we've looked at when you've had really strong gains through October, and what does that mean for the final 2 months of the year? And when you're up more than 20%, the final 2 months of the year have been up 8 out of 8 times with gains of around 6%. Again, maybe you pull forward some of that, but we still think there's some upside, especially as you relieve some of these anxieties that we're seeing in the market recently.
I know you've looked at it, Keith. I tweet all your work as soon as it hits my email inbox. Keith Lerner, Co-CIO over at Truist. Have a good week.